Look at this diagram. In a split second, which of these two lines is longer? Your brain probably screamed that the bottom one is stretching out further. But if we drop guides straight down, we see they're the exact same length. You fell for it because of a cognitive shortcut called a mental heuristic. Biologically, your brain is wired to conserve energy, and analyzing every detail takes too much power. So instead of doing the heavy lifting, it takes the easy way out. It bypasses deep processing entirely and makes an instant, superficial judgment based purely on what looks right at a glance. Skipping that analysis is totally harmless for a simple visual test. But when you apply that exact same survival mechanism to your money, it exposes a massive vulnerability. Open any trading app today, and you are immediately hit with a wall of numbers, flashing tickers, and erratic charts. Actually analyzing a company's balance sheet or verifying its historical performance requires intense cognitive processing. It's the exact type of heavy lifting your brain actively tries to avoid. To solve that problem, your mind substitutes a heuristic shortcut. You look at a stock, see a recognizable name or an upward-pointing chart, and decide it feels like a solid play. Riding that wave of unearned confidence, you hit the buy button. Because you skipped the foundational math, that entire trade is built on a cognitive illusion rather than financial reality. You've just walked right into a trap. This chart shows what often happens next. Almost immediately after you buy, the price plummets well below what you paid for it. The logical move is to sell, cut your losses, and move on to a better asset. Yet most investors completely refuse to do it. To understand why, imagine you're on a long road trip. You pull into a drive-thru and pay $20 for a premium combo meal. You take a bite and the burger is cold. The fries are completely stale and the soda is flat. You are not enjoying a single second of it. You should just throw it out. But instead, you force yourself to eat the whole thing anyway because you already paid for it. This is known as the sunk cost fallacy. Your brain tricks you into enduring a miserable experience simply to justify money you've already spent and can never get back. That stale burger is your failing stock. You hold on to an asset that is actively draining your account purely because your original capital is already committed. Now, compare that to what happens when you actually get a trade right. You buy a different stock, and it immediately jumps up into profit. Suddenly, panic sets in. You rush to hit the sell button, locking in a tiny gain before the market has a chance to take it away from you. This creates a glaring paradox. Our psychology makes us eager to cut our winning trades short out of fear, while we patiently hold on to our losing trades out of pure stubbornness. Meanwhile, that original stock keeps dropping. Your portfolio is bleeding out, and the financial damage is getting severe. The reason you still refuse to surrender comes down to a final psychological hurdle called loss aversion. Human beings process financial outcomes with a severe asymmetry. The pain of losing money hits your brain drastically harder than the joy of making it. This chart visualizes that exact imbalance. Researchers have found that a financial loss registers as roughly 3 times more painful than an equivalent gain registers as pleasurable. Avoiding that intense, magnified psychological blow becomes your dominant goal. You become completely blind to the actual market data sitting right in front of you. In a desperate attempt to avoid realizing that pain, you deploy one final tactic: averaging down. This diagram shows how the math works. You buy 100 shares at $100. The price crashes, so you buy another 100 shares at $95, artificially pulling your average cost per share down to $97.50. You feel like you're getting a discount, but the harsh reality is that you are just throwing good money after a bad decision. You are actively magnifying your own financial ruin. Durable stock market success demands an active, conscious fight against the biological wiring that once helped our ancestors survive. By recognizing and short-circuiting these 3 specific traps, heuristics, sunk costs, and loss aversion, you can finally stop letting your evolutionary instincts bankrupt your portfolio.